Hello and welcome back to another accounting video in which we're going to talk about acquisition of property, plant and equipment. In this particular exercise, we're going to focus on the financing aspect of the acquisition. In this case, we're told that we have signed a notes payable, but it's a zero interest bearing note. And we all know that there's no such thing as zero interest. It's implied in the note. So we'll see how it's going to affect the valuation of our asset. So in this exercise, we're told that Cardinals Corporation purchased a computer on December 31st, 2019 for $105,000, paying $30,000 cash down and agreeing to pay the balance in 5 equal installments of $15,000 payable at December 31st, beginning on 2020. An assumed interest rate of 10% is implicit in the purchase price. So that's that interest rate. It's not really zero. So we'll see how to calculate that. We've been asked to do the journal entries on the date of acquisition and the first two interest payments and the amortization. We'll see how to deal with that. Now they've told us to keep it to 2 decimal places, and we'll try to be true to that instruction that has been given over here. So our first journal entry is going to be on the date of acquisition. So let's start out with some things that we know. We know that we have acquired a computer, so the asset has to be debited. I'm going to leave one line and then I'm going to write cash. I know how much cash I paid over here. The amount of cash I paid is $30,000. It's a $105,000 asset minus the $30,000. The notes payable is going to be for the balance, which is $75,000. Obviously, interest is included in this, and we're going to call that discount on notes payable. So how do we do this calculation and arrive at that number? For that, we are looking at the time value of money table, and we'll see how to do that calculation. So here what I have is I'm going to create a table, and I'll start out with the dates that are relevant. We're going to do only 3 journal entries, but I have this done all the way through the life of the asset. So I have the relevant dates being the date of acquisition and the 5 times I'm going to make the installment payments. The installment payments are, we already know, $15,000 each time to add up to the $75,000. That's a notes payable. We have the interest calculations and the amortization that we need to work on. But before that, we need to find out what is the present value of the $75,000. So the present value of $75,000 is a present value of the series of cash flows. So I have a series of cash flows, that's an ordinary annuity. So I need to calculate the present value of an ordinary annuity. The interest rate is 10% and the number of periods is 5. The number of payments is 5. 5 payments are going to be made. So when we look up our time value of money table, the discount factor I have is 3.79079. Multiply that by 15,000, you arrive at 56,861.85. I'm keeping it to 2 decimal places because that's what the problem asked me to do. Okay, so that's the present value of the note, 56,861.85. That number plus the 30,000 is the value of the computer. So basically, if I had paid all cash for it, I would be paying 86,861.85 for that asset. Instead, I have agreed to pay 30 plus 75. The 75 is spread over five years, but I'm paying a total of $105,000 for a computer that's really worth 86,861 today. That's the present value. So the difference over here, the plug number is my discount on notes payable. Now that I have that in place, I can, for the first payment that I'm going to make, I'm going to set up my journal entry over here, and I'll use the table over here to fill up the information in the journal. So first thing I know is notes payable has to be debited. I'm paying notes payable $15,000. Okay. I'm going to have interest expense. That interest expense is basically that discount on notes payable is the interest. Now I'm going to start spreading out, recognizing that interest now. And I have a cash payment. how much cash am I paying? It's 15,000 that payment. Okay, so it's 15,000. So the question over here is, of this 15,000 that is paid, how much of it is interest and how much of it is towards the principal? So the interest is previous carrying value, in this case it's the opening carrying value, times the 10%. That gives me 5686.19. The difference between these two numbers is the amortization. So that's how much I paid towards the principal of the note payable that's outstanding. Okay, so the next period, I go to the same journal entry and I pretty much can copy this information down in terms of account names that are debited and credited. What's also going to stay the same is the $15,000 for the note payable and $15,000 for the cash. That stays the same. Now the interest expense, I need to recalculate that number. Okay, how do I calculate it? 10% multiplied by the previous balance. So 10% of that previous balance is going to be my interest expense. Again, the difference between these two is going to be the amortization, and that reduces the face value of my notes payable further down. Okay, so that number now is 4754.80. That's the interest expense. So you could continue, I'm going to copy and paste this all the way through, and we'll see what happens at the very end. At the very end, this has to become 0. Now, if you add up all the interest amounts, it's going to be the 18,138.15. It's basically this number. What we said was the interest. That's a number that we're going to recognize over the 5-year period. What you will notice is the interest expense each time keeps decreasing, and the amortization, paying off of the principal, gradually increases. This is the same concept as when you have a note on a car or note on a home. When you're paying off for a home, let's say you have a traditional 30-year mortgage, this is exactly what you see. Initially, the amount of interest expense you're going to pay is very large. The portion that's interest expense is going to be very large, and towards the principal, it's going to be very little. So the longer the time period, the more interest you're going to pay. So once again, in this example that we've looked at, we have an asset that's acquired. It tells us it's 0 interest bearing, which means I don't pay interest separately, but that $15,000, there is implicit interest in it. And the implicit interest over a 5-year period is $18,138.15. So this is yet another example of acquisition of an asset, different ways of financing it. In this case, we've looked at a 0 interest note. We looked at a previous example where we had an interest bearing note. We looked at acquiring assets by way of paying cash, giving stocks, giving our inventory, even getting it for free by way of a donation, a contribution that the city makes to if they want me to do business in this town. So these are the various ways in which we could acquire an asset. Again, the focus still is on valuation. What should that asset be valued at the point of acquisition? Because that effectively is a historical cost, which is going to stay in my books. And for assets other than land, all other property, plant, and equipment, they need to be depreciated. So coming up with the right value of that asset is extremely important. This affects a variety of items that are going to be presented in my balance sheet, and obviously also the income statement. So with that, we will conclude the acquisition of assets and move on to another concept of interest calculation, and that is dealing with self-constructed assets. And that's going to be our next video.